Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Wednesday, April 29th, 2026, and we're here to break down yesterday's most talked about market insights.
That's right, Ethan. Our AI dug through a significant volume of social media discussions and market commentary from Tuesday, April 28th. We saw a really high number of posts flagging many different stocks, and I'd say the overall sentiment is, well, it's pretty complex and nuanced today, with some serious highs and some definite lows.
Absolutely. A real mixed bag, which makes for a fascinating hunt. Let's dive into some of the most prominent tickers on our radar.
First up today, we have Robinhood, ticker HOOD. It saw a huge spike in discussion yesterday after its latest earnings.
You know, despite some immediate negativity, there's a strong undercurrent of optimism for Hood out there. Many users are still viewing it as a long-term play, believing it'll bounce back to the $100 to $120 range within the next year. And we did see some insider buying, which often signals confidence from those closest to the company. That 42% net profit margin historically looks pretty good too.
Ethan, while the community's long-term hope is noted, we really need to look at the immediate data. Our analysis shows a significant Q1 earnings and revenue miss, with crypto revenue down by a whopping 47%. That's a major hit to a core segment. Plus, the stock's current price is quite a distance from its 52-week high, and its price-to-earnings ratio at over 40 indicates the market was already baking in substantial growth. A miss like this makes that valuation very difficult to sustain, especially with a debt-to-equity ratio over 136.
Good points, Brooke. So for Hood, considering that recent earnings report really shook things up,
my market commentary suggests that for now, despite the community's hopeful outlook, it's a stay away. The KPIs just aren't supporting that short to medium-term rebound right now. It's a downgrade from some recent cautious buy ratings for sure.
Fair enough. Next, let's talk about Reddit, ticker RDDT. The chatter around this one is incredibly bullish.
Oh, it's definitely buzzing. Users are throwing out some wild price targets, like $250 after earnings and an ambitious $500 by year-end. There's a strong conviction from some investors, even suggesting aggressive buying strategies. Ethan, are you seeing this?
I am, Brooke, and it's exciting. With upcoming earnings due out tomorrow, April 30th, and talk of potential S&P 500 inclusion, those are some serious catalysts that could fuel growth. Plus, we're seeing news about new shopping tools being tested to boost revenue. The 69.7% revenue growth and 24% net profit margin are already strong indicators of potential. This could really show some dramatic upward movement.
But Ethan, we've got to ground that enthusiasm in the numbers. RDDT's price-to-earnings ratio is already very high at 56.46, and the PEG ratio, which factors in growth, is at 1.25, suggesting it might already be overvalued relative to that growth. Those targets of $250 and especially $500 are significantly above its 52-week high of $282.95. Achieving those would require not just exceptional earnings, but continued aggressive multiple expansion, which is a big ask. Remember, we've consistently had stay-away or speculative gamble ratings on RDDT in the past.
You're right, the volatility is definitely something to consider with that high beta. So for RDDT, despite the strong community conviction,
it's another stay-away. The market commentary is highly speculative, and the fundamental KPIs don't robustly support those aggressive price targets.
All right, shifting gears to energy, let's discuss BP, ticker BP. This one has been generating a lot of heat, literally and figuratively.
Understatement of the day, Ethan. Our analysis shows overwhelming negative sentiment from users, focusing on ethical concerns and accusations of price gouging, especially with their profits more than doubling.
But Brooke, you can't ignore the strong financial performance. Q1 profits more than doubled, beating expectations, and rising oil prices are certainly a tailwind. Goldman Sachs even raised their Brent forecast. Plus, we saw significant insider buying, over 10 million net shares purchased in the last 6 months. That's a huge vote of confidence.
Insider buying is compelling, I agree. However, the user sentiment is critical here, linking those surging profits to moral and economic wrongs. The company's net profit margin is actually very low at 0.029%, and its PE ratio over 37 for a mature oil company is quite high. Ethical outrage often leads to political scrutiny, and the long-term shift towards alternative energy is a fundamental risk to the entire industry. The stock is also near its 52-week high, which could be vulnerable to profit-taking if public pressure mounts or the energy transition accelerates. So even with those strong Q1 numbers, my AI-generated insights tell me it's a stay away. The reputational and long-term industry risks, amplified by the public backlash, outweigh the short-term financial gains. This is a first-time mention for BP, so it sets a baseline.
Okay, let's move to Avis Budget Group, ticker CAR. The sentiment here seems pretty clear.
It's crystal clear, Ethan. Our analysis shows overwhelming bearish sentiment. Discussions are centered around users profiting from a massive price drop, with the stock described as having been, quote, fully juiced and proceeded to dump. It fell from an incredible $847.07 to around $182 in just a few days.
That's a dramatic fall, no doubt. But I did notice some very significant insider buying, over 870% of total insider shares purchased in the last 6 months. Could that suggest insiders see value after such a sharp correction, anticipating a rebound?
While insider buying is usually a positive signal, in this case it's largely overshadowed by deeply concerning fundamental KPIs. The company is operating at a loss with negative EPS, negative net profit margin, and negative revenue growth. Its price-to-book ratio is also negative, which often signals severe financial distress. With such high volatility, reflected by a beta of nearly 2, and upcoming earnings, this situation is incredibly precarious. We've consistently rated CAR as stay away in previous episodes for these very reasons.
Yikes!
So for CAR, even with insider confidence, it's unequivocally a stay away. The fundamental financial health indicators are flashing red.
All right, Brooke, let's wrap this up with our daily roundup.
Sounds good, Ethan. Here are today's top candidates for deeper analysis based on our market commentary. Investigate as buy? None. Investigate as cautious buy? None. Investigate as speculative gamble? Reddit, RDDT. And that's our deep dive for today. Just a quick reminder to our listeners, this podcast is for informational and entertainment purposes only. The content you've heard is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses incurred. The market is a wild place and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you tomorrow with more AI-generated market insights.